January 9th, 2026 quietly became a date markets will remember. Silver slipped under $80 and traders immediately felt something change. This move was not panic selling or random profit taking. It came after silver delivered a historic 150% rally. Few assets in modern markets move like that without consequences. The pullback felt controlled but emotionally heavy for many investors. Just days earlier, silver was trading confidently above $80. Momentum looked strong and sentiment felt almost unstoppable. Then suddenly, price paused and direction shifted slightly. Media rushed to label it a simple correction. Experienced traders knew corrections rarely feel this deliberate. Silver was not acting like a normal speculative asset. This move carried weight beyond a few dollars lost. 1 year earlier, silver traded near $30 quietly. It was ignored, dismissed, and labeled boring for years. By late 2025, it shocked almost everyone. $70 arrived faster than institutions expected. That alone forced analysts to rewrite long-held assumptions. January 9th was not about price falling. It was about silver entering a new psychological phase. Markets tend to pause when something structural changes. This was not fear, but recalibration. Smart money reacts slowly, not emotionally. They observe confirmation before committing further. Silver had just broken a 40-year ceiling. That alone rewired how institutions viewed risk. For decades, silver failed above $50 repeatedly. Every attempt ended with disappointment and collapse. Traders learned to sell early out of habit. That habit died in 2025. Once a ceiling breaks, belief systems break too. January 9th tested whether the breakout was real. Price pulling back does not erase structural change. It often confirms it. Markets test conviction after historic moves. Weak hands exit, strong hands observe quietly. This is where long-term trends are decided. Silver was no longer a fringe trade. It became a macro discussion. Central banks, miners, manufacturers, all paid attention. Supply constraints were no longer theoretical. Physical silver was already becoming harder to source. This moment forced markets to slow down and reassess. The question was no longer if silver mattered. The real question became how far this shift could go. January 9th marked the beginning of that conversation. This move forced traders to zoom out instead of reacting emotionally. Silver was no longer trading inside old historical behavior. A breakout after 4 decades changes market psychology permanently. Long-term ceilings create deep-rooted selling habits. Those habits collapse once price holds above resistance. Silver did exactly that during 2025. The market stopped treating $50 as a sell signal. That alone triggered institutional recalibration models. Risk desks had to update long-standing volatility assumptions. January 9th tested whether new buyers would panic. They did not exit aggressively. Selling pressure remained controlled and orderly. That behavior signals confidence, not fear. Sharp crashes usually come with emotional volume spikes. This pullback came with discipline and structure. Another key factor was dollar movement during that session. The US dollar showed temporary strength across currency markets. A stronger dollar naturally pressures metals short term. That relationship has existed for decades. However, silver did not collapse under dollar strength. That divergence caught professional attention quickly. It suggested internal demand remained strong. When fundamentals overpower currency pressure trends, survive. This was not retail-driven buying. Institutional positioning was clearly involved. Funds do not exit positions instantly after structural shifts. They scale adjust and observe reactions. Silver pricing showed that exact behavior. Another overlooked detail was timing before major data releases. Markets often reduce exposure ahead of uncertainty. January 9th occurred before key U.S. economic reports. Caution was logical, not bearish. Smart capital waits for confirmation, does not chase highs blindly. This phase separates speculation from positioning. Silver entered positioning territory. That shift matters more than daily price swings. Meanwhile, physical market signals remained tight. Premiums did not collapse alongside spot prices. That divergence revealed underlying supply stress. Paper markets adjusted faster than physical markets. This gap often precedes larger moves. Traders who understand structure watch these gaps closely. January 9th created one of those moments. The market was whispering, not shouting. Those who listened gained clarity. What made this moment different was physical supply reality. For 5 straight years, silver demand exceeded production. That is not a temporary imbalance. It is a structural supply issue. Mining output could not accelerate fast enough. Most silver comes as a mining byproduct. Gold and zinc production control silver availability. Higher silver prices do not instantly increase supply. That constraint limits market flexibility. Industrial demand kept expanding regardless of price. Solar manufacturing alone consumed massive silver volumes. Electric vehicles increased silver usage per unit significantly. Data centers added another unexpected demand layer. Artificial intelligence infrastructure accelerated consumption further. These sectors cannot substitute silver easily. Conductivity and reliability requirements remain strict. That locks demand even during price volatility. Meanwhile, exchange inventories kept declining quietly. Shanghai Futures Exchange showed decade-low stockpiles. Physical metal was leaving vaults consistently. Low inventories reduce shock absorption capacity. That increases sensitivity to sudden demand spikes. Markets notice inventory trends before headlines do. This was happening beneath surface pricing. Lease rates began rising gradually. Borrowing physical silver became more expensive. That signals reluctance to lend metal. Holders preferred retaining inventory. That behavior reflects expectation of higher value. Paper markets reacted faster than physical markets. Physical buyers showed no urgency to sell. That disconnect matters historically. Similar patterns appeared before previous commodity repricings. This does not guarantee immediate upside, but it changes long-term probability curves. Another subtle signal was ETF behavior. Outflows slowed despite price pullback. That suggested conviction remained intact. Retail panic selling did not dominate flows. Institutional positioning stayed disciplined. This phase rewards patience, not prediction. Silver was no longer chasing momentum. It was building acceptance at higher levels. That process takes time, not headlines. Markets rarely move in straight lines. But structure reveals direction eventually. China's role cannot be understood through headlines alone. China rarely explains its strategy publicly. Instead, it acts quietly and consistently. Silver inventory data revealed this behavior clearly. Shanghai exchange inventories fell to multi-year lows. That decline was not accidental. Physical metal was being absorbed steadily. No panic buying was visible. No sudden selling appeared either. This indicates planned accumulation. China's industrial demand explains part of this trend. Solar panel manufacturing dominates global output. Silver remains essential for photovoltaic efficiency. No viable replacement exists at scale. Electric vehicle production reinforced demand pressure. Each EV requires significantly more silver components. Sensors wiring and control systems depend on it. AI infrastructure added a third demand pillar. Data centers consume silver intensely. Cooling systems and circuitry rely on conductivity. China expanded data center construction aggressively. That expansion increased baseline silver consumption. But industrial use alone does not explain hoarding. Strategic behavior becomes visible through inventory retention. Metal was not returning to exchanges. That suggests long-term holding intentions. Lease rates confirmed reduced lending willingness. Borrowers paid more to access physical silver. Such conditions rarely appear randomly. They usually reflect confidence in future scarcity. Paper markets reacted slower to this signal. Physical markets moved first, as usual. This pattern appeared before other commodity repricings. China understands supply chain leverage deeply. Control over inputs influences global production pace. Silver impacts energy technology timelines directly. That creates strategic value beyond price speculation. Meanwhile, Western markets debated forecasts publicly. China focused on securing material quietly. Different philosophies produce different outcomes. One seeks prediction, the other seeks positioning. Physical accumulation reduces exposure to volatility. It also limits downside availability. That tightens future supply further. The cycle reinforces itself gradually. It does not require immediate price spikes. But it reshapes long-term market structure. Silver became less liquid in reality. Liquidity illusions persist only temporarily. Eventually, price aligns with physical truth. Federal Reserve policy sits at the center of silver psychology. Interest rates influence silver through multiple hidden channels. Lower rates weaken the dollar naturally. A weaker dollar supports commodity pricing globally. Silver responds quickly to currency shifts. Holding silver carries no yield cost advantage. Higher rates reduce its attractiveness temporarily. Lower rates remove that pressure immediately. Late 2025 rate cuts change silver momentum sharply. January pricing reflects policy uncertainty now. Markets expect rates to hold near term, but expectations shift faster than policy itself. Fed communication created mixed interpretations recently. Some officials hinted at aggressive easing possibilities. Others emphasized patience and data dependence. This divergence injected uncertainty into forecasts. Uncertainty increases volatility across commodities. Silver benefits during volatility expansions historically. Dollar strength briefly pressured silver prices downward. That pressure remained technical, not fundamental. Bond yields stabilized without breaking lower yet. Stable yields reduce panic selling behavior. Investors began reassessing metal positioning calmly. Silver's drop reflected positioning cleanup, not a rejection of long-term demand. Paper markets reacted to macro headlines. Physical buyers remained active quietly. This divergence signals structural strength beneath noise. Currency traders focused on upcoming data releases. Employment reports influence rate expectations directly. Strong jobs delay easing assumptions. Weak jobs accelerate accommodation narratives. Silver responds asymmetrically to this data. Upside reactions exceed downside historically. That asymmetry attracts strategic allocation interest. Institutional models adjust slowly to new regimes. Retail narratives react faster but shallow. The Fed does not target silver directly. Yet its policy shapes silver outcomes indirectly. Liquidity conditions matter more than rhetoric. Liquidity expansion favors hard assets long term. Tight liquidity creates temporary pullbacks only. January represents a recalibration phase. Markets digest prior excesses carefully. Silver remains sensitive but resilient. This balance defines transitional periods. Transitions create opportunity for informed positioning, not through predictions, but preparation. Understanding policy context reduces emotional reactions. Silver pricing now reflects macro patience. Patience precedes decisive movements historically. Institutional disagreement around silver is unusually intense. Major banks rarely diverge this sharply on commodities. Bank of America turned bullish unexpectedly. Their forecasts shocked conservative investors. They cited yield pressure and ETF inflows. UBS remained cautious, but open to upside. They emphasized controlled growth scenarios. ING projected moderate averages through 2026. Their view assumed stable global expansion. Scotiabank stood alone on the bearish side. They predicted sharp reversion toward lower levels. Such divergent signals uncertainty, not clarity. Markets pay attention when experts disagree. Disagreement increases volatility probability. Volatility creates asymmetric opportunity windows. Industry insiders told a different story. Primary silver producers see supply constraints daily. Mining executives understand geological limitations. Production cannot scale quickly despite prices. New discoveries take years to materialize. Existing mines face regulatory pressure. Environmental rules slowed expansion globally. Labor shortages added further friction. Supply elasticity remained historically low. Demand elasticity moved opposite direction. Industrial buyers showed price tolerance. Solar manufacturers prioritized supply security. Electric vehicle producers locked contracts early. AI infrastructure required reliable material sourcing. Silver became operationally non-optional. This demand behaved inelastic. Price dips did not reduce consumption. Instead, dips triggered accumulation. Institutions observed this behavior carefully. Models struggled to incorporate physical scarcity. Paper pricing underestimated real constraints. Physical markets revealed different signals. Premiums widened quietly. Delivery times extended unnoticed publicly. This divergence confused traditional forecasts. Forecasts rely on liquid markets. Silver increasingly traded outside liquidity assumptions. That shift changed risk dynamics. Institutions recalibrated allocation frameworks. Long-term positioning replaced short-term trading. This transition unsettled momentum traders, but rewarded strategic patience. Markets rarely broadcast such shifts loudly. They reveal themselves slowly. Silver's behavior reflected this transition. Conflicting forecasts became information, not noise. Understanding disagreement prevents emotional bias. Silver moved beyond consensus frameworks. That usually precedes repricing phases. While banks debated forecasts, China acted quietly. China rarely signals intentions through media. It moves through accumulation and execution. The first signal appeared in Shanghai inventories. Exchange reports showed decade-low silver stockpiles. This was not seasonal fluctuation. It reflected sustained physical withdrawal. Physical metal stopped returning to vaults. Lease rates increased steadily. Borrowing silver became expensive. That signals reluctance among holders. Holders do not lend scarce assets. They protect strategic resources. Delivery delays became common. Paper buyers requested physical fulfillment. Fulfillment timelines extended unexpectedly. This created stress between paper and physical markets. Two pricing realities began diverging. Paper prices reflected liquidity assumptions. Physical prices reflected scarcity pressure. China operates primarily in physical markets. Western markets dominate derivatives. This structural difference matters. Physical markets dictate long-term pricing. Paper markets dictate short-term volatility. China prioritized industrial continuity. Solar manufacturing consumed massive silver volumes. Photovoltaic production requires silver paste. There is no efficient substitute. EV manufacturing amplified demand further. Electric vehicles use significantly more silver. Sensors, wiring, and power systems require it. AI infrastructure intensified consumption patterns. Data centers rely on silver conductivity. China expanded AI capacity aggressively. That expansion required material security. Strategic stockpiling became logical, not speculative. Chinese institutions rarely chase price. They secure supply chains. This mindset differs fundamentally from trading culture. Accumulation occurred during price dips, not during headlines. This behavior stabilized downside pressure. Western traders underestimated this factor. Models ignored sovereign scale buying. Inventory depletion confirmed sustained absorption. This absorption removed metal from circulation. Removed metal does not reappear quickly. Scarcity builds silently. Prices respond later. China did not announce strategy. Markets inferred it. Inference created uncertainty. Uncertainty fuels volatility. Volatility rewards preparation. This east-west divergence reshaped silver dynamics. The market no longer behaved uniformly. Understanding this split explains price behavior. Silver was no longer just a trade. It became a strategic asset. While China absorbed supply, the dollar shaped prices. The US dollar influences commodity valuation globally. A stronger dollar pressures metals temporarily. A weaker dollar supports commodity expansion. In early January, dollar strength increased slightly. This applied short-term pressure on silver. Traders interpreted this as profit-taking, but structural demand remained unchanged. The Federal Reserve sat at the center. Rate policy defines dollar momentum. Markets expected rates to remain unchanged. Holding rates stabilizes currency temporarily, but stability does not eliminate liquidity expansion. The Fed balance sheet quietly expanded again. Reverse repo operations increased system liquidity. Liquidity flows eventually seek hard assets. Silver benefits from excess liquidity, especially when yields fail to compensate inflation. Real yields remained compressed. That reduces opportunity cost of metals. Investors reassessed cash positioning. Cash loses appeal during prolonged inflation. Precious metals regain relevance. Dollar weakness does not happen instantly. It unfolds in phases. First stability, then erosion. Silver reacts ahead of currency shifts. Markets price future conditions early. This explains resilience during pullbacks. Fed communication remained deliberately vague. Uncertainty allowed volatility expansion. Volatility creates opportunity for accumulation. Institutional players scale positions quietly. They avoid headlines. They follow macro alignment. Dollar pressure increases import costs. Energy prices reinforce inflation concerns. Oil and metals often move together. Rising energy costs support hard assets. This creates cross-commodity reinforcement. Silver benefits indirectly, not from speculation, from systemic imbalance. The market sensed this shift. Reactions became slower and more deliberate. Aggressive selling diminished. Buyers stepped in selectively. This behavior suggested confidence. Confidence does not announce itself. It appears through price response. Dollar influence remained temporary. Structural forces remained dominant. Silver reflected that balance. Retail investors reacted emotionally to price drops. Short-term pullbacks triggered panic selling. This reaction repeated familiar historical behavior. Professionals interpreted weakness differently. They viewed pullbacks as positioning windows. Psychology defined market separation. Retail sought certainty. Institutions accepted uncertainty. Uncertainty creates pricing inefficiencies. Inefficiencies invite strategic capital. Many retail traders chased confirmation. Confirmation always arrives late. Late entries increase downside exposure. Institutions scaled during doubt. Scaling reduces timing risk. This difference explains long-term outcomes. Fear dominated retail sentiment. Patience dominated institutional behavior. Patience compounds advantage. Markets reward discipline over urgency. January volatility amplified emotional mistakes. Thin liquidity exaggerates price movement. Exaggeration triggers poor decisions. Professional desks remained inactive publicly. Silence does not indicate absence. It indicates preparation. Options positioning revealed hedging, not exit. Hedging reflects risk management. It does not signal bearish conviction. Volume patterns confirmed accumulation. Selling pressure lacked follow-through. Buy orders absorbed weakness. Absorption supports structural trends. Retail focused on headlines. Institutions focused on flows. Flows reveal intent more than commentary. Silver volatility tested conviction. Weak hands exited early. Strong hands waited. Waiting aligned with macro direction. Macro conditions remained supportive. Supply constraints persisted. Industrial demand showed no slowdown. Physical premiums stayed elevated. That confirmed real-world scarcity. Scarcity supports long-term pricing. Price noise masked deeper alignment. Alignment eventually asserts itself. This phase filtered participants. Only disciplined capital remained engaged. The market prepared for resolution. Resolution follows consolidation. Silver continued consolidating strength. Institutional confirmation does not arrive through headlines. It appears through behavior consistency. Price stability replaced emotional swings. Volatility compressed gradually. Compression signals internal agreement. Agreement does not require optimism. It requires alignment. Alignment forms before expansion. Expansion follows acceptance. Silver entered acceptance quietly. Traders stopped forcing direction. Price respected ranges calmly. That calm confused most observers. Calm often precedes acceleration. Acceleration requires preparation. Preparation happens during boredom. Boredom filters impatience. Impatience exits early. Committed capital stays. Commitment reveals conviction. Conviction does not chase confirmation. It waits for validation. Validation comes from structure. Structure strengthened beneath price. Support zones held repeatedly. Repeated defense builds confidence. Confidence reduces forced selling. Reduced selling tightens supply. Tight supply amplifies future moves. This phase is invisible emotionally. It is visible structurally. Institutions measure structure. Retail measures excitement. Excitement fades quickly. Structure persists. Silver respected higher lows consistently. That pattern reflects strength. Strength without momentum frustrates traders. Frustration creates exits. Exits reduce noise. Noise reduction improves clarity. Clarity attracts scale. Scale requires trust. Trust builds slowly. January behavior reflected trust building. Not euphoria, not fear, just discipline. Markets reward discipline eventually. Silver prepared quietly. The next move required patience. Patience separated outcomes. This phase defined positioning. Positioning decides results. Macro triggers do not announce themselves loudly. They surface through pressure accumulation. Pressure builds when systems stretch. Stretching shows up in currencies first. The US dollar began signaling fatigue, not collapse. Fatigue. Fatigue weakens momentum dominance. Dollar strength stalled instead of advancing, and that pause mattered more than headlines. A paused dollar changes commodity behavior. Commodities respond to currency balance. Silver reacts faster than gold. Because silver trades dual roles, it is monetary and industrial simultaneously. That duality amplifies sensitivity. Dollar hesitation supported silver stability. Stability invited institutional patience. Patience allowed layering. Layering absorbs volatility. Absorption creates base strength. Base strength resists panic selling. This resistance was visible in volume behavior. Volume normalized instead of spiking. Normalization indicates professional presence. Professionals avoid emotional volume. They prefer consistency. Consistency builds quietly. Meanwhile, bond yields stopped pushing higher. Yield stagnation eased pressure on metals, not a rally catalyst. A pressure release. Pressure release prevents breakdowns. Breakdowns require force. Force was missing. That absence mattered. Markets do not fall without pressure. They drift when pressure disappears. Silver drifted sideways with purpose. Sideways action frustrates speculation. Speculation leaves early. Long-term positioning remains. That transition changes market ownership. Ownership defines trend durability. Durability requires time. January provided time. Time filtered weak conviction. Filtered conviction strengthened structure. Structural integrity improved daily. No breakout needed yet. Preparation was enough. Markets often prepare longer than expected. That is where most mistakes occur. Traders confuse delay with failure. Institutions see delay as opportunity. Opportunity expands when patience dominates. Dominance shifts quietly. Quiet shifts are powerful. Silver entered that shift zone. The market was no longer fragile. It was waiting. Waiting is not indecision. Waiting is alignment. Alignment precedes movement. Movement follows readiness. Readiness does not rush. It allows confirmation. Confirmation was forming, not in price spikes, in behavior stability. That stability mattered more than forecasts, because forecasts react. Behavior leads. Silver behavior signaled preparation. The next phase depended on timing. Timing depends on catalysts. Catalysts were approaching. Market resolution never comes randomly. It arrives through scheduled pressure points. Those pressure points are economic releases. January concentrated multiple releases together. Jobs data sat at the center. Employment defines consumption capacity. Consumption drives industrial demand. Industrial demand anchors silver value. Strong jobs stabilize demand expectations. Weak jobs amplify policy speculation. Speculation increases volatility. Volatility forces decision-making. That is how resolution begins. Another catalyst was inflation trajectory. Inflation did not collapse. It cooled unevenly. Uneven cooling complicates policy choices. Policy hesitation supports metals. Because uncertainty increases hedge demand. Silver benefits from hedge behavior, especially when gold feels crowded. Crowding pushes rotation. Rotation favors undervalued assets. Silver remained undervalued relative to use. Use continued expanding. Solar production accelerated globally. EV manufacturing maintained momentum. AI infrastructure spending remained elevated. These were not forecasts. They were confirmed trends. Confirmed trends reduce downside risk. Risk perception shapes positioning. Lower perceived risk invites scale. Scale occurs gradually. Gradual scaling avoids spikes. Avoided spikes reduce exhaustion. Exhaustion kills trends. Silver avoided exhaustion intentionally. Another catalyst approached through liquidity. Central bank balance sheets stabilized. Liquidity did not contract aggressively. That stability mattered. Liquidity supports asset confidence. Confidence delays forced liquidation. Delayed liquidation strengthens bases. Bases support expansion phases. Expansion requires triggers. Triggers were scheduled. Markets were not guessing. They were waiting for confirmation. Waiting compresses energy. Compressed energy releases directionally. Direction emerges suddenly. Sudden does not mean chaotic. It means prepared. Prepared markets move efficiently. Efficiency attracts capital. Capital follows clarity. Clarity was forming, not through commentary, through alignment. Alignment synchronized macro signals. Signals pointed toward balance. Balance favors metals accumulation. Accumulation builds without noise. Noise alerts retail. Silence favors institutions. Institutions prefer silence. Silence protects execution. Execution changes structure. Structure determines outcome. January was shaping structure. Structure determines February direction. Silver was positioned, not exposed. That distinction mattered. Exposure reacts. Positioning anticipates. Anticipation controls risk. Control defines professionals. This phase separated participants, not by knowledge, by patience. Patience filtered conviction. Conviction prepared movement. The next move required alignment completion. Completion was close. Markets knew it. Silver reflected it. The setup was nearly finished. What followed would not need explanation. Behavior would speak. Market outcomes do not appear suddenly. They unfold through probability alignment. Probability alignment depends on reaction. Reaction reveals intent. Intent reveals direction. Silver reactions became controlled. Control replaced panic. That transition mattered. Because panic ends trends. Control extends them. Institutions respond to control. Retail responds to excitement. Excitement faded quietly. Quietness supported accumulation. Accumulation requires time. Time compresses supply. Compressed supply raises sensitivity. Sensitivity amplifies future moves. That is structural behavior. Another element was dollar behavior. Dollar strength paused. Pause did not reverse, but it softened pressure. Soft pressure supports metals, especially when yields stabilize. Yields stopped rising aggressively. Stability reduced liquidation risk. Reduced liquidation protects bases. Bases absorb selling. Absorption strengthens floors. Floors invite confidence. Confidence brings scale. Scale increases participation. Participation spreads risk. Spread risk stabilizes markets. Stability attracts long-term capital. Long-term capital avoids noise. Noise was absent. Absence was intentional. Another signal came from options markets. Implied volatility cooled. Cooling suggested comfort. Comfort indicates preparedness. Prepared markets move cleanly. Clean moves last longer. Silver was preparing, not accelerating. Preparation confused many observers. Confusion creates mispricing. Mispricing attracts professionals. Professionals exploit confusion patiently. Patience controlled timing. Timing mattered more than price. Price follows positioning. Positioning had shifted, not publicly, internally. Internal shifts define cycles. Cycles do not announce themselves. They transition quietly. Silver entered transition. Transition favors disciplined actors. Discipline filtered participation. Filtered participation improved quality. Quality improves durability. Durability supports continuation. Continuation depends on catalysts. Catalysts were approaching. Data would finalize alignment. Alignment would unlock direction. Direction would not surprise prepared participants. Only late observers. Late observers chase. Chasing increases volatility spikes. Spikes attract distribution. Distribution punishes impatience. Patience avoids punishment. Silver rewarded patience historically. This phase repeated that pattern, but with different drivers. Drivers were industrial, not speculative. Industrial demand does not exit quickly. Exit requires replacement. Replacement was unavailable. That scarcity underpinned value. Value held firm despite pullbacks. Pullbacks tested conviction. Conviction remained intact. Intact conviction supported structure. Structure prepared expansion. Expansion awaited confirmation. Confirmation was near. Markets felt it. Silver reflected it quietly. The next phase would reveal commitment. Commitment defines outcome. Markets rarely move on belief alone. They move on confirmation stacking. Confirmation stacking happens slowly. Slow phases feel uncomfortable. Discomfort pushes weak hands out. Weak hands exit early. Strong hands wait. Silver entered a waiting phase. Waiting was misread as weakness. It was actually filtration. Filtration improves market quality, matters more than speed. Speed creates mistakes. Mistakes create losses, teach. Discipline defines survivors. Survivors control future pricing. Another factor was liquidity flow. Liquidity did not vanish. It shifted lanes from momentum trades into structured positioning. Structured positioning reduces noise. Noise confuses retail sentiment. Confusion increases misinterpretation. Misinterpretation fuels wrong exits. Wrong exits benefit. Accumulation continued quietly. Quiet accumulation avoids headlines, invites speculation. Speculation increases instability. Instability was absent confirmed control. Another signal came from futures spreads. Backwardation pressure eased. Easing suggested supply stress normalization. Normalization does not mean abundance, it means better distribution. Distribution improves delivery confidence. Confidence reduces forced selling. Forced selling breaks, trends remained intact. Silver respected higher structure. Respect matters. Technically, respect attracts algorithms. Algorithms respond to consistency. Consistency improves liquidity. Depth reduces slippage. Reduced slippage encourages size. Size brings institutional flow. Institutional flow stabilizes volatility. Stability attracts longer horizons. Longer horizons ignore short dips. Short dips test patience. Patience filtered participants again. Filtering repeated the process. Each repetition strengthened the base. Bases grow through repetition. Growth prepares breakout conditions. Breakouts require energy. Energy accumulates during boredom. Boredom discourages attention. Lack of attention reduces crowding. Reduced crowding lowers crash risk. Crash risk remained low. Low risk attracts calculated exposure. Calculated exposure builds ladders. Ladders scale upward gradually. Gradual scaling prevents exhaustion. Exhaustion ends rallies. Silver avoided exhaustion. That was intentional. Another element was macro alignment. Rates paused, dollar stabilized. Commodities adjusted calmly. Calm alignment supports metals, especially industrial metals. Silver sits between categories. That dual role increases complexity. Complexity creates pricing inefficiency. Inefficiency creates opportunity. Opportunity rewards preparation. Preparation requires understanding structure. Structure was visible, but not obvious. Obvious moves attract crowds. Crowds arrive late. Late arrivals fund exits. Exits had not started. That absence mattered. Silver held interest. Interest did not spike. Spikes signal climax. No climax appeared. That suggested continuation potential. Continuation requires trigger. Trigger would come from data or policy or supply confirmation. Multiple paths existed. Markets were aware. Silver reflected awareness, not urgency. Awareness without urgency is powerful. It signals readiness. Readiness precedes movement. Movement favors those aligned early. Alignment was still forming. This phase defined winners, not headlines, not opinions. Positioning did. Silver positioning was deliberate. Deliberate actions last longer. That was the real signal. At this stage, markets ask one question. Who is actually committed? Commitment shows through behavior, not through words. Silver behavior stayed disciplined. Discipline limits downside damage. Limited damage preserves confidence. Confidence sustains positioning. Another layer was options activity, implied volatility, cooled. Cooling suggested reduced panic. Reduced panic supports base building. Base building needs time. Time filters impatience. Impatience exits first. Exit pressure remained controlled. Controlled exits signal strength. Another signal came from open interest. Open interest held steady. Steady interest means no mass exit. No mass exit confirms conviction. Conviction differs from excitement. Excitement fades quickly. Conviction compounds quietly. Silver showed compounding behavior. Compounding creates asymmetry. Asymmetry favors prepared capital. Prepared capital plans scenarios, not predictions. Scenario 1 involved continuation. Continuation required stability above structure. Structure remained respected. Scenario 2 involved consolidation. Consolidation required time. Time was available. Scenario 3 involved breakdown. Breakdown needed aggressive selling. Aggressive selling never appeared. That eliminated Scenario 3. Remaining scenarios favored patience. Patience aligned with institutional rhythm. Institutions move slower. Slower movement reduces error. Reduced error increases consistency. Consistency attracts follow-through. Follow-through extends trends. Trend extension does not rush. It waits for confirmation, builds sequentially. Silver confirmations stacked quietly. Each stack reduced risk. Risk reduction invites scale. Scale changes market character. Character shifts precede repricing. Repricing never announces itself. It happens gradually. Gradual changes or ignored moves persist longer. Persistence defines real trends. Silver displayed persistence. Another confirmation came from correlation. Silver decoupled from short-term noise. Decoupling shows independence. Independence strengthens narrative. Narrative eventually attracts capital. Capital follows clarity. Clarity was forming, but not complete. Incomplete clarity delays crowd entry, delayed crowds, benefit early alignment. Alignment was still possible. That was the opportunity window. Windows close without warning. Markets rarely signal closure. They simply move. Movement punishes hesitation. Hesitation comes from confusion. Confusion was widespread. Widespread confusion is bullish. Bullish because consensus lacked. Lack of consensus supports continuation. Continuation depends on next catalyst. Catalysts were approaching, data releases, policy commentary, physical supply updates. Any could trigger momentum. Momentum would follow structure. Structure was intact. Intact structures resist collapse. Resistance builds trust. Trust invites commitment. Commitment scales price. Scaling price shifts perception. Perception lags reality. Reality leads price eventually. Silver reality pointed upward bias. Bias did not mean straight line. Pullbacks remained part of process. Process mattered more than price. Those who understood process stayed calm. Calm outperforms emotion. Emotion exits early. Early exits fund later rallies. This cycle repeated historically. History does not repeat exactly, but behavior rhymes. Silver behavior rhymed with accumulation phases. Accumulation precedes expansion. Expansion rewards patience. Patience remained the edge. That was the lesson. Attention now shifted toward catalysts, define direction. Direction follows preparation. Preparation favors informed positioning. Upcoming data mattered more than headlines. Jobs data shaped rate expectations. Rates influenced dollar strength. Dollar strength impacted metals pricing, but silver reacted selectively. Selective reaction showed maturity. Mature markets absorbed noise, no longer controlled price. Price responded to structure instead. Structure remained stable. Stability discouraged short selling. Short sellers lacked conviction. Lack of conviction reduced volatility. Lower volatility invited capital. Capital prefers calm environments. Calm environments allow accumulation. Accumulation precedes trend extension. Trend extension requires trigger. Triggers do not arrive daily, they arrive unexpectedly. Prepared markets respond faster. Silver positioning looked prepared. That preparation showed through flows. ETF flows stabilized. Stabilization removed downside pressure. Physical demand stayed persistent. Persistence outweighed speculation, exited earlier. Remaining holders showed intent. Intent differentiates traders from investors. Investors think in phases. Phases unfold sequentially. Silver entered transition phase. Transition phases confuse crowds. Confused crowds hesitate. Hesitation delays participation. Delayed participation fuels later moves. That dynamic remained active. Another factor emerged quietly. Central bank language softened. Soft language reduced shock risk. Reduced shock risk stabilized bonds. Bond stability eased equity stress. Equity calm supported risk assets. Silver benefited indirectly. Indirect benefits compound slowly. Slow compounding builds sustainability. Sustainability supports long trends. Long trends rarely feel exciting early. Early stages feel boring. Boring phases create opportunity. Opportunity requires discipline. Discipline was rewarded historically. Silver rewarded discipline before. Pattern consistency mattered. Consistency builds confidence. Confidence encourages scale. Scale attracts visibility. Visibility draws broader interest. Interest expands participation. Participation pushes price discovery. Discovery resets valuation. Resetting valuation takes time. Time remains the variable. Markets do not rush repricing. They confirm gradually. Gradual confirmation reduces reversals. Reduced reversals protect capital. Capital protection sustains engagement. Engagement strengthens trend integrity. Silver integrity stayed intact. External risks existed, but risk does not equal failure. Risk creates range. Range builds base. Base supports breakouts. Breakouts require patience. Patience separated winners. Winners did not predict. They observed. Observation guided response. Response remained measured. Measured actions outperform emotional ones. Emotion creates mistakes. Mistakes fund opportunity. Opportunity cycles endlessly. Silver entered another cycle. Cycle awareness mattered. Awareness reduced fear was minimal. Minimal fear supported structure. Structure guided. Next move awaited confirmation. Confirmation would come through data, not opinions. Those waiting understood timing, rewarded preparation. Preparation defined advantage, remained available. But not forever. Markets close windows quietly. Quiet closures trap late entries. Early alignment avoids traps. Silver alignment remained early. That defined the setup. At this stage, clarity mattered more than speed creates mistakes. Mistakes transfer money. Transfers reward patience, defined positioning. Positioning reflected conviction. Conviction reduced noise response. Noise lost influence gradually. Gradual shifts change outcomes. Outcomes follow structure. Structure remained unbroken. Unbroken structures attract trust. Trust attracts longer capital. Longer capital stabilizes trends. Stability builds confidence quietly. Quiet confidence outperforms hype. Hype already exited earlier. Early hype burns fast. Burnout leaves opportunity. Opportunity attracts disciplined actors. Disciplined actors wait for confirmation. Confirmation emerges from data. Data rarely surprises prepared markets. Prepared markets react calmly. Calm reactions protect momentum. Momentum grows without drama. Drama invites volatility, punishes late emotion. Silver avoided emotional extremes. That restraint mattered. Restraint often precedes expansion. Expansion requires participation, grows slowly. Slow growth sustains trends. Sustainable trends last longer. Longer trends reward consistency, separates strategies, outperform guesses, depend on luck. Luck fades quickly, structure endures. Endurance defines value, attracts institutions. Institutions move deliberately. Deliberate moves reduce reversals. Reduced reversals encourage holding tightened supply. Tight supply supports price floors. Price floors define downside risk. Downside risk remained contained. Containment improved risk profiles. Improved profiles increased allocation comfort. Comfort brought incremental buying. Incremental buying builds pressure. Pressure accumulates unseen. Unseen pressure releases suddenly. Sudden releases surprise crowds. Crowds react late. Late reactions fuel continuation, defines trend phases. Trend phases repeat historically. History rarely repeats perfectly, but patterns rhyme. Silver's pattern rhymed clearly. Clear patterns invite attention. Attention changes narrative. Narratives drive sentiment. Sentiment influences behavior. Behavior shapes price action. Price action validates thesis. Validation builds conviction. Conviction encourages scale in behavior. Scale in avoids timing errors. Timing errors destroy discipline. Discipline preserved advantage. Advantage favored preparation. Preparation stayed active. Active preparation reduces stress. Stress causes premature exits. Exits weaken positioning. Strong positioning stayed intact. That strength mattered going forward. Forward focus replaced hindsight. Hindsight adds no value. Forward analysis defines outcomes. Outcomes remained open. Open outcomes create opportunity. Opportunity rewards those watching. Watching beats predicting. Predicting creates bias. Bias blinds judgment. Clear judgment matters now. Now is transition time. Transition phases test patience. Patience remained the edge. The edge stayed available, but edges shrink over time. Time compresses opportunity. Opportunity does not announce itself. It fades quietly. Those attentive notice shifts. Shifts begin subtly. Subtlety defines early stages. Silver remained in early stage awareness. Awareness creates advantage. Advantage defines positioning. Positioning defines outcome. Outcome remains unwritten, but structure favors continuation. Continuation requires discipline. Discipline decides success. That was the real signal. This phase required awareness more than action. Action without clarity leads to error. Error feeds volatility. Volatility transfers wealth. Wealth transfers favor. Prepared players act with intent. Intent reduces hesitation, creates missed entries. Missed entries create regret clouds. Judgment. Clear judgment stays neutral. Thinking protects capital. Capital preservation enables longevity. Longevity compounds advantage. Compounding beats timing. Timing depends on emotion already exited earlier. What remained was structure. Structure supported continuation. Continuation required confirmation. Confirmation develops through behavior. Behavior reflected confidence. Confidence showed in positioning. Positioning stayed measured. Measured exposure reduces drawdowns. Reduced drawdowns preserve psychology. Psychology drives decisions. Decisions shape outcomes. Outcomes follow preparation, stayed consistent. Consistency stabilized expectations. Stability encouraged holding tightened availability. Tight availability supported price integrity. Integrity attracted institutional interest. Institutional interest moved slowly. Slow movement avoided spikes. Avoiding spikes reduced exhaustion, ends rallies. This rally avoided exhaustion. Avoidance extended lifespan. Extended lifespan attracted analysis. Analysis replaced speculation. Speculation already burned earlier. Burned speculation cleared noise. Noise removal revealed fundamentals. Fundamentals remained unchanged. Supply stayed constrained. Demand stayed persistent. Industrial demand stayed active. Monetary demand stayed cautious. Cautious demand lasts longer. Demand stabilizes cycles. Stabilized cycles attract capital. Capital flows follow structure. Structure remained intact. Intact structures resist panic. Panic never materialized. Absence of panic mattered. Markets fear panic. Silver avoided fear. Avoiding fear preserved trust. Trust builds slowly. Slow trust endures. Endurance defines trend maturity. Maturity had not arrived yet, that mattered. Early phases offer asymmetry. Asymmetry rewards patience. Patience stayed available, but availability narrows over time. Time compresses opportunity. Opportunity favors awareness. Awareness beats prediction. Prediction fuels bias. Bias destroys discipline. Discipline remained the edge. Edges are temporary. Temporary edges require respect. Respect means preparation. Preparation means understanding. Understanding replaces reaction. Reaction loses advantage. Advantage stayed with structure. Structure favored continuation. Continuation remained conditional. Conditions depended on data. Data remained pending. Pending data held attention. Attention remained focused. Focus separated observers from participants. Participants positioned deliberately. Deliberate positioning reduces regret. Regret belongs to late action. Late action chases headlines. Headlines already passed. What mattered now was alignment. Alignment between supply and behavior. Behavior confirmed tightening. Tightening supports floors. Floors define risk. Risk stayed controlled. Controlled risk enables confidence. Confidence sustains trends. Sustained trends reward patience. Patience defined success here. That was the takeaway. Not excitement, not fear, not prediction, understanding.